Hello, everyone. This is Grace Cavantes and Mike Eklund here for your January 2024 quarterly market update. We appreciate everyone joining us again. We do this on a quarterly basis. If you haven't checked our website yet with further details from previous webinars in the past. We're going to go through about 10 slides today, talking through what happened in 2023 and some thoughts on what we think is going to happen in the future as well. Before we get going, the first thing is just a disclaimer, just as a reminder that this is for informational purposes only. It should not be used as investment advice. If you are a financial symmetry client, I highly recommend reaching out to your advisor with specific questions on your portfolio. So with that, I will hand it off to Grace, who's going to talk a little bit about what happened in the global equity markets in 2023.
For our first slide today, we get to see a summary chart of how global markets performed in 2023. There was a lot of negative news throughout the year. For example, talks of recession, Silicon Valley Bank closing, Fitch reducing the US credit rating, and then, of course, the Israel and Hamas war. So a lot of negative news, but despite all of that, global stock markets were still up quite strongly for the year. And this is a good reminder for me and hopefully for you that things can sometimes feel uncertain, but that doesn't necessarily mean it's a bad time to stay invested. Next, Mike, can you share with us more detail breaking down how the different markets did in 2023?
Thanks, Grace. Yes, after a challenging, as many know, a challenging 2022, 2023 was very strong in terms of for global stocks and bonds. So this chart here takes a look at over the last year in 2023. For stocks, the U.S. stock market was up over almost 26%. International and emerging market stocks were up about 18% and 10% respectively. And even global real estate through REITs were up about 10%. And then the bond market, which had a very difficult, really 2021 and 2022, did very well at over 5% for U.S. bonds and over 8% for international bonds as well. So the chart also includes information on performance over the last 5 and 10 years. In reality, the equity markets have done well over the last 5 and 10 years, especially the U.S. stock market. So we're going to have a further slide talking a little bit about what we think that means for the next 10 years. But overall, it's been a very strong U.S. stock market return, at least over the last 10 years or so. So with that, I will hand it off to Grace, who talks a little bit about, given that strong stock market, should that change your investment approach?
So with the strong returns we saw in 2023, fortunately and naturally, we're hitting a lot of market highs, which is really exciting, except when it might make you stop and think, is now a good time to be investing my cash? Because if it's high right now, does that mean it's going to go back down? And so this chart shows us historical returns of both cash being invested at market highs and non-highs. And fortunately, we can see that the returns end up being fairly similar at 1-year returns, but especially at 3- and 5-year returns after market highs and non-highs. So now can still be a great time to invest your cash.
So that's a great takeaway, Grace. So it doesn't matter if we have market highs or the market is down. It's always a good time to invest if you have the funds. So the next slide we want to chat about. So if you've been following the investment news over the last year, you may have heard the phrase Magnificent Seven stocks. Sorry about that. And this is really 7 stocks, including Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla. And after a rough 2022 for these stocks, 2023, they did extremely well. And I think we did in the previous webinar, we talked a little bit about their performance. But what this slide is trying to show you is that the price you're paying for those stocks, as you see here on the top, is significantly more expensive than what you're paying for the same companies in the S&P 500, for example, or the All Country World Index, which is all companies in the world. So, right now you're paying over 4 times in terms of the valuation for these 7 companies versus the companies globally, which historically, when you see such a high price, which we saw a little bit in the late 90s, future returns are typically lower. We'll talk about in the future, but we don't have a crystal ball. We just want to make people aware if they're just saying, hey, why don't I just buy these 7 stocks? They've done so well. There is a risk to that approach. So with that, I will pass it off to Grace, who talked a little bit about that risk in terms of what historically has happened when a company becomes one of the largest 10 in the U.S. stock market.
Yes. So we currently have the Magnificent Seven, but over the decades, we've had different mixes of other Magnificent 7 or 5 or 10 companies that at that time people invested in it or wanting to invest in it thought these companies are the best companies. They're going to continue to be the biggest and the best. And so often a lot of money funnels into those stocks. But what we can see from this chart is that that same top 10 companies changes from decade to decade. And so the ones that we have that are the biggest right now are not what people expected to be the biggest in 2010. In 2010, people had their eyes on Walmart or P&G, and a lot of other companies that right now are not being noted in that Magnificent Seven. So even thinking back multiple decades, you could see that General Electric was one that's been in the top 10 for different decades, but currently is not. So I'm sure there were many investors that were invested that for a long time and thought they're always going to be the biggest, they're always going to be the best, and they're not. So it's something to keep in mind as we select where we want to invest, that just because something looks really, really good right now does not mean it's going to continue to always stay there. Companies change, new companies come up, and so what might be the Magnificent Seven in 10 years from now is probably going to be a little different from now, maybe entirely different. We don't know for sure, but we do know that over time these things change.
No, that's a great point, Grace. I'm looking forward to see this same graph in 2030 and see what's on the list, because I'm sure there's names on there that we never even thought about that are the top 10. So this is the great thing about capitalism. That's how it evolves over time. So with the next slide, speaking of, we talked on one of the earlier slides about how strong the S&P 500 did over the last year and over the last 10 years. So this was a good slide from BlackRock that looks over the last about 23 years and compares the S&P 500 versus a diversified portfolio, which owns U.S. stocks, international stocks, bonds, and looks at the performance over those last 23 years. And it's somewhat interesting that the diversified portfolio and S&P 500 ended up at about the same point. Actually, diversified portfolio did slightly better, but along the way, you see there's many different results. For example, after the tech bubble crash of 2022, the diversified portfolio did much better, only lost 15% versus 40% for the S&P 500. But moving forward, as we said, this last year, 2023, the S&P 500 did much better at 26% versus a diversified portfolio at about a 15% return. But this gets back to kind of at financial symmetry. We believe that a diversified portfolio is a better fit longer term. Those highs won't be as highs, those lows won't be as lows. It also takes out the risk that what if we had like a 2000 where the S&P 500 had negative returns for the entire decade. So that just shows you that over those 23 years that they took different routes, but they both ended up at the same point. And then the next slide here, this is one that I always enjoy looking at every year. This is from Morningstar, and what they do is, we don't have a crystal ball. None of these investment firms do, but they do a lot of research and diligence to kind of come into what do they think what's going to happen over the next 10 to 15 years in the stock and bond market. And so what Morningstar does is they compile the expected return forecasts from these six firms to get an idea of what the expectations are in the future. Now, financial symmetry, we find this very helpful with our financial planning process because we have to assume some type of returns. We also find this very helpful for our investment process to get a sense of, where is the best place to invest our clients' money in the future. I think two key takeaways I want people to remember from this slide. The first is all six of the investment firms expect the international markets, developed and emerging markets, to outperform the U.S. stock market over the next 10 to 15 years, which is somewhat shocking. If you look at from the previous slide we discussed, the U.S. stock market did outperform these markets pretty handily over the last 10 to 15 years. But as we saw during the 2000s, their expectation is because those valuations are so different in terms of the U.S. stock market is so much more expensive right now than the international markets, they do expect the international markets to outperform over that time period. And then in addition, which people have probably noticed in their bank accounts as well as their, the bonds, if they hold any, you're getting somewhat of a return today. They're expecting somewhere 5 to 6% in bond returns, where a few years ago that was 0 to 1 to 2%. So you're actually getting paid something to hold bonds today, which is obviously a benefit to investors as well. So I think this is a good takeaway as well to keep, remember, if you want to invest, focusing on the future, not on what's happened in the past.
That is a great reminder. Thanks, Mike. All right, as we wind down, we do like every quarter to remind our clients in particular, but of course, anyone who's interested, that we have a 3-step investment process here at Financial Symmetry, which starts with developing your investment plan, and we implement the investment plan, and then ongoing, we monitor it. It's not a set it and forget it. It is an ongoing process. Beyond that, thank you so much for joining us today. If you are a Financial Symmetry client and have any questions about your portfolio, please reach out to your advisor. If you have any questions for us, our contact info will be on the next slide. You can reach out to Mike and me, or check out our website, financialsymmetry.com, if you would like more information. And again, thanks for joining, and we'll be back next quarter.